topic of the day. And we haven't even mentioned this one, Todd. Your tagline that we used for so many years about disinheriting the IRS. So I guess now's the time to work on that disinheritance. Tell me what you think.
This time of year, everybody's looking at their finances, their income next year. The holidays are staring us in the face, and everybody's wondering what they're going to spend on and with their family. But a lot of people are facing some significant losses in some of the stocks or mutual funds that they own. And so I want to talk about how people can evaluate their portfolio and disinherit the IRS a little bit this year.
Great. So give us a couple ideas. And obviously, before you get started, I do want to mention Todd is not going to be giving us any individualized financial advice. If you want that, you can give me a call at 800-306-1990. I will put you in touch with Todd Halterman. That's what he does for a living, is help people with that kind of guidance. So what are some of the things that you should be looking at right now, Todd?
Well, last week I helped a couple who had lost a significant amount of money on a certain stock, and they were wondering what should they do? Should they hang on to it? Should they sell it? And I said, well, long term, the company is a really strong company, but short term, let's make some moves, because they had another stock that had gone up quite a bit. So what I did, Ron, is I instructed them to sell $75,000 of their stock. And let's just say that stock was Boeing. That stock got sold for a loss, and that $75,000 sale triggered a significant loss. Then what we did is we sold a Lockheed Martin, which had a significant gain. And those two sales offset each other. So we took the capital gain out of Lockheed Martin at 75,000, and we took the loss on Boeing, so they offset each other. But here's the trick. So we zeroed that out. They loved both positions. We moved $75,000 into an ETF that had Lockheed Martin and Boeing in it. So they're not going to miss anything that bounces around in those two positions, but they get to record the loss to offset the gain. Now, the other $75,000 we put into an energy program that gave them $70,000 of ordinary income deducted off of their tax return this year. So we took two sales of stock at $75,000 and gave them $70,000 off their tax return and income, and wiped out the gain of the Lockheed Martin stock. So that is proper tax harvesting.
I like that idea. So, but they still like both of those positions. Now, is there an ETF that only has that, or is it maybe like a defense ETF or something along that has that and gives them more diversification?
There are specialty ETFs that you can find in the world of finance that give you an example: aerospace and defense. There are some ETFs and unit investment trusts that have 12 to 25 companies in it that make up the largest companies that have distribution in the aerospace and defense markets. Happens to have Lockheed Martin and Boeing in it. But in order to record the tax deduction for the gain and the loss, it has to not go back into that same company for at least 31 days. So all that means is we can put it in an ETF that has those companies in it, but it can't go back into the individual position for 31 days. So we're going to park it in that ETF and decide in 31 days whether they want to go back into the stocks or just keep the ETF.
So help me understand this. What's the benefit if I've lost 75, I've gained 75, I like both positions, why wouldn't I just stay there?
Well, because you have a big gain on Lockheed Martin that you're wiping out, and you're not getting out of the position. So when Lockheed goes up more, you'll realize more appreciation, but you just wiped out 0% tax on all that capital gain of Lockheed Martin, and you're not going to miss the uptick if Lockheed Martin goes up in the next 31 days. So you're staying in the position still, Ron, but you're tax harvesting right now to wipe out that $75,000 gain, if you will.
I got you. Okay, so at the end of the day, then I can go back in and put another, buy another 10 shares of each of those. And then we basically started zero on both. Our anticipation, and I don't care what the number is, I'm just throwing that out there.
Sure.
So the bottom line then becomes, okay, now I'm back in the position, and my guess, just as a guess, things equal out, right? So Lockheed may be a little more flat because it's already gone up so much, and Boeing, being that it was down so much, that might be the winner, but we just don't know.
But in the next year, you could see Lockheed go down, and then you'll be able to record a loss where Boeing might go up. But the bottom line is you're harvesting that big gain at a 0% tax, and you're not moving yourselves out of those sectors or those positions, and you really dilute your risk because now you're going to an ETF with 12 to 25 companies instead of those individuals. And the other 75,000, we created another additional income deduction on the tax return of $70,000. So who in California would like to reduce their ordinary income by $70,000 on their tax return?
While protecting what they've already earned, what they've already gained, right? That's
Right.
always a big issue, is because who knows what tomorrow brings. Now this particular family, they've protected a gain with no tax expense. Love that idea.
You know what else? You know what else we did, Ron?
What's that?
That $70,000 of ordinary income credit that they got, we converted $70,000 of IRA into Roth.
Holy cow! So now they've got that deduction. They're not going to have to pay taxes on the IRA, and any gains on the Roth, because of it being a Roth, grows tax free. Amazing.
That's what planning does.
Amazing. That's why you got to call Todd Halterman, because now when all these documents get taken to the CPA or in the enrolled agent in March or April or whenever, well, they're going to see a much better picture on their tax returns than they might have thought of getting rid of taxes. So Todd, dig a little bit deeper into what, as a financial planner, you look at when considering the conversion from an IRA to a Roth.
Well, first thing you have to look at is, where is their marginal tax bracket at? What tax bracket are they in? And so converting the IRA to Roth is going to trigger, obviously, top marginal bracket tax rates. And we want to avoid people going from a 12% tax bracket to a 22% tax bracket, because as you can do the math, that's an 80% increase in tax. We also want to be mindful of Social Security tax and triggering other taxation that we didn't see before. So the first thing we evaluate is, where are they at in their current tax rates with their current income, the way that they do their tax returns today. That's the initial analysis that has to happen. The second thing that we do then is we calculate, what are they going to invest in, and how long do we expect it to them to take to get the tax growth back. So generally, in an average market, it's going to take a consumer 2 to 4 years to grow their tax money back, and then that money is tax-free growth the rest of their life. So it just depends on what they want to invest in after we calculate what's the real tax impact to taking the money out of the IRA to put it in the Roth.
So let me ask you this, because I'm not the tax guy, and I don't even play one on TV. But let's say I'm right square in the middle of that. You mentioned a 12 or a 22%.
Right.
So let's say I'm right in the middle of that, or maybe my income has got me to a point that I'm over after they do all my adjustments, and we do a technical analysis. That's why I say you got to talk to your CPA right now, or your enrolled agent, or whoever's doing your taxes. And I'm like, say, Todd, say I'm in 15%. I'm a few thousand over that 12%. Can't get it any lower. And I've got some space till I get to the 22. Can I convert part of my IRA to Roth?
Well, you can convert part of your IRA to Roth, but if you're just over and you have no more deductions, then if you're over the 12% line, now you're in 22%. And depending on what state you live in, you'll have state tax on top of that. It gets into that 30 to 34% tax level. And that gets a pretty big bite out of your IRA conversion. That could take 5 years to make that back in what I'll call a stagflation market. So our recommendation is, work with a qualified financial planner and tax accountant, CPA, to calculate if you could invest in oil and gas right now, which is a very bullish market, and get tax deduction, ordinary income tax deduction, that will allow you to take your income below that marginal bracket and convert some of that IRA to Roth without getting into that next tax bracket. So like my prior example, the client invested $75,000 into an energy program, got $70,000 of ordinary income taken off their tax return. Because that income was off their tax return, we went ahead and moved $70,000 of the IRA into the Roth, and they washed each other out. And then that client in the Roth took that money and invested in more Lockheed Martin and Boeing stock inside the IRA.
So that doesn't trigger that 31-day rule that you mentioned?
No, it does not. It's inside a qualified plan. The IRS does not oversee qualified plan sales because there's no taxable interest in the qualified plan whether you buy or sell.
Wow. So, you're looking at all these different things. Now, let me ask you this, because I know that there's a lot of folks that say, something, I can't talk to Todd because I got to talk to my CPA or whoever their financial planner is. Do the financial planners and the CPAs commingle, or so to speak? Do they talk to each other, or are they at odds?
Well, in a perfect world, you'd like to think they work together, but it's not often that you'll see a financial planner call a CPA to work with them, and they both. The CPA doesn't generally call a financial planner either. But it is practiced by some real professionals, and if people out there are not working with both their tax accountant and their financial planner together, they're not being as efficient with their financial planning as they should. So oftentimes you'll find that they don't, because that might just lead to the CPA wants to do it one way, the advisor wants to do it another way, and then the client becomes confused.
And that's the biggest challenge, because you're hiring two people that you believe are qualified and very good, and then all of a sudden you're getting two different opinions. And being that we're not the expert, we say, "Holy cow, what am I supposed to do? I'm just sitting here as the guy that's trying to get some good advice, and I don't know what to do." So we're going to continue our conversation with Todd Halterman, because I know that Todd works with the CPAs, and it's kind of like, you don't want to find a bunch of people that are egotistical, right? It's about the issue is, hey, how do we work together for the betterment of, or getting the best solution? And in this case, the idea of disinheriting the IRS. In the last segment, I threw it out there that you need to have what I've coined, I should probably trademark this, household board of directors, right? Because, you listen to the news, and if you follow any financial news, and I know it's hard to listen to the news anymore, but some of us do. But, you listen to Apple, you listen to Google, you listen to what Todd's been talking about, Boeing and Lockheed Martin. They all have boards of directors. Why? Because not everybody leading the company knows everything there is to know about everything, right? I know a little bit about doing a radio show. I've been doing it for 12 years. I've talked to financial planners. Todd's a good friend of mine, and I've learned a tremendous amount from him. I am not qualified to do what he does. I've talked to CPAs. I'm not qualified to do that. I think I'm qualified to lead a lending team. That I do on a regular basis, and I've done that for many, many years, decades. But the bottom line is, you need the financial planner, Todd Halterman. You need the CPA. You need the estate planning attorney. You need the insurance agent. You need all these folks to guide you, and you're just the spoke in the middle. Not just, but you are the hub in the middle of the spokes, I guess is the way you put it. But if they're not going to talk to each other, and if someone's going to get their ego in the way, I'm going to say maybe you need to replace them. Just throwing that out there. That's just my opinion. What do you think, Todd?
Well, there's a difference between tax preparers and tax mitigators. And oftentimes consumers don't really know the difference. And if they have a good financial advisor, that advisor can quarterback things and go in and speak with that accountant to help them kind of be on the same team about the goal. And the end goal is helping the client make more money and keep more of it. but that is a necessary interview that people out there should do. They should try to have them work together. They will give you an example. Many consumers out there right now, Ron, are going to get 1099s in February that say they've got a bunch of capital gains tax to pay on mutual funds that they lost money in. So how do you lose money in a mutual fund and then you end up getting a 1099 where you're paying $1,000 in capital gains tax on an asset you lost money in? Very frustrating.
Yeah, that would be a frustrating one, because you're looking at your 201k statement. It used to be a 401k, but if you don't have a great tax planner, you're looking at that and it's dropped. Or you look at your stock portfolio, because that's what you're paying taxes on, and that's dropped. And yeah, you're right. That would be frustrating. Now, there's accounts out there that'll kind of act like your own household mutual fund, don't they?
Yes, you can set up several types of chassis where you can build your own little internal mutual funds, and not many consumers know how to do that. But I would advise to make a plan first and understand how to do that before you start doing it on your own.
I know I shouldn't ask this because I know it's would be self-serving, but do you find very many people that are successful when they try to do it on their own? Right? Because they can't compete with the amount of time you spend getting educated on these things.
There's so many smart people in the world. So I'll just tell you that Vanguard, one of the leading research companies in the world, comes out with studies ever so often. In January of last year, they came out with a new white paper that said people that use professionals like myself make an average of 3% more net per year than they do doing it on their own. And that's Vanguard statistic from all the research that they do. And if you average 3% more, let's just say that goes to 9 from 6. That's a 50% increase in return. So, but some people just don't like to give up control, and a lot of folks are afraid what somebody like me is going to sell them, and they just aren't ready for that kind of advice, and that's okay. But sooner or later, you're going to have to trust somebody. So I'd suggest you start interviewing.
And I'm going to throw one other one out there that a lot of people they're not willing to articulate, but I will. Right? They want to look at it and they say, something, I don't want to have to pay a commission. And my point is, who cares? Does it matter if you're going to net more money? Does it matter what you pay?
Well, I can tell you that same consumer will go to Macy's and Nordstrom's for their clothes instead of Big Lots. Yeah.
and ironically enough, the same people will also say, something, I wish I had the money of, I don't know, some big time investor, not FTX and not that guy, but it used to be, Todd, you'll probably know the numbers better than me. A qualified investor, it used to be they had to have, I think, 5 million in non-residential assets. And they'd go to a hedge fund, and the hedge fund charges, it used to be 20% of the profit plus 3% for management. Think about the most sophisticated individuals, the wealthiest of individuals, want to pay the highest commissions. I wonder why that would be. Do you think that's because they're stupid?
Well, they're evaluating the net of fee returns that they're paying for. They're investing in professional advice rather than having it cost them. But again, everybody's situation is different, and we want to keep fees and expenses low. And not every asset a consumer owns needs to be billed a management fee. If a person has an asset that's just paying 6% standard interest because it's a fixed note or preferred stock, and it's not going to go up or down in value, why are they paying a fee to have somebody hold that for them? You see, I believe that some assets deserve to be parked in a brokerage account. Some assets do need to be actively managed. And if you don't know the difference, you need to get an audit.
Yeah, that's a key thing right there, is get that audit. And I love it. Linda Eisenman, you bet. Why wouldn't you pay a professional who's going to make you money? That's the bottom line. I mean, I say that all the time is, even in real estate, the real estate agents are going to get you more money than you're going to get if you try and sell on your own. And maybe and I'm going to throw this at you, Todd, also, because I know we only got about a minute left. I bet it's going to keep you out of trouble, right?
Well, here's the fun part, Ron. Sorry about that. The fun part is I had a client who lost $80,000 of their money in bad trades, and the wife wanted to divorce him. So how expensive was that stock loss? You see, if that had happened and I was their professional, all they have to do is fire me and keep their marriage.
There you go. Love that concept. Hey, really appreciate you coming and helping us out, Todd. If you want more information, if you want to talk to Todd about these strategies, I love that one. Equal out the $75,000 gain so you don't have to pay any taxes on it. Put it into another fund and convert IRA that's going to be taxable into Roth and saving money there. Look at all those things. We talked about all that today. If you missed any of it, wow, go back and listen to the replays. RonSiegelRadio.com in the archives.